Hello, traders. Welcome back to the first episode of the comprehensive course on options trading. The Indian derivatives market segment has been skyrocketing of late. For context, the derivative turnover has jumped from 210 trillion rupees in financial year 2018 to 500 trillion rupees in FY 2024. The participation has skyrocketed too, with F&O segment participation increasing to 9.6 million in FY 2024, which is over 40% more than the previous year figures of 6.5 million. Looking at these crazy numbers, you may be led to believe that this popularity is a byproduct of consumer success and that people who trade futures and options walk away with loads of money. But this is not the reality. 9 out of 10 individual traders in equity futures and options segment incur net losses according to a SEBI study. But still, people are coming in flocks. I have given you a brief context on why options are such a popular instrument in the previous episode. But there can be other reasons like fin influencers who contribute to the buzz around derivatives, especially among younger, naive investors. While some influencers spread financial education, there are others who give unauthorized trading advice, showing off their profits, thereby making futures and options trading a buzzword in India. Yet, if you ask any of these option traders about what an options contract is, most of them would fail to answer because they only care about profits, overlooking the risks and technicalities. Let's try to change this. In this video, we will understand what an options contract is using a real life example. So, if these series of episodes are helping you to learn and improve, please make sure to like this video. Don't hesitate to comment down your questions and suggestions. Share this video with your friends and fellow traders. And if you are new to this channel or you have not already subscribed, make sure to subscribe and also enable the bell icon to be notified when a new episode gets released. As I have mentioned in the previous episode, there are two types of options, the call option and the put option, and you can be a buyer or seller of these options. For a start, let us understand what the call option contract means using real world examples. And once you get a hold of this example, we will understand the same in stock market context. Then, we will look at an example to understand put options in the stock market scenario. So let's get started. Consider this real estate situation involving a call option like arrangement with a developer. You are actively evaluating an opportunity to buy a house. After some searching, you have become interested in purchasing a house that is currently under construction as a part of a villa project. The market value of the house after completion is 50 lakh rupees. This house fulfills your family's needs and fits within your budget. The location of the villa project is outside the city limits. But there are rumors about a new bypass road project that connects the two cities nearby. Assume that the villa project will be completed after 3 months, and the clarity regarding the bypass road sanctions will also be available after 2 months. After 2 months, if these rumors regarding the bypass road project indeed turns out to be true, you anticipate that once the house is completed, its market value might increase significantly due to factors such as anticipated developments in the neighborhood and increasing property values in the area. This could result in your dream house going over budget, and you will not be able to afford it anymore. You really don't want to lose out on this opportunity. But at the same time, you are also concerned if the house will lose the present market value if the project turns out to be just a rumor, and you will be buying the house at a much higher price. So there is so much at stake. Anyways, you go and meet the developer and you express your interest in purchasing the house once it's completed. The developer seems quite happy to sell the house to you, but you want to play it safe. After thinking through the whole situation, you propose a special structured arrangement to the developer, which you believe is a win win for both of you. Instead of committing fully to the purchase at the current market price, you opt for a call option like agreement. The key terms of the agreement are as follows. The market value of the house after completion is 50 lakh rupees. This is the fixed amount that you are willing to pay for the purchase. This agreement gives you the right to exercise the contract after 3 months. You pay an upfront fee of 1 lakh rupees to the developer. This fee compensates the developer for granting you the right to purchase the house at a predetermined price of 50 lakh rupees after 3 months. This is a non-refundable agreement fees that you pay for the developer's risk. Because you have paid an upfront fee, only you can call off the deal at the end of 3 months if you want to, but the developer cannot do so. In the event you cancel the deal at the end of 3 months, the developer gets to keep the upfront fees that you have paid. Now, After agreeing upon this contract, both parties would have to wait for the next 3 months to figure out what would actually happen. Clearly, the price of the house will vary based on the outcome of the bypass road project. However, irrespective of what happens to the bypass project, there are only three possible outcomes with regards to the market value of the villa project. If the bypass road project becomes a reality, then the market value of the land would rise up. Let's say it shoots up to 60 lakh rupees. Another scenario is when the road project does not come up. People are disappointed, and the market price of the house collapses, say to 45 lakh rupees. Another scenario is when the road project doesn't come up, yet nothing happens, and the price stays flat at 50 lakh rupees. These are the three possible scenarios regarding the price of the fully constructed house after the end of 3 months' time. Now, depending on the current market value of the house, you get to decide if you want to proceed with the deal or drop it. Let's analyze each outcome and come up with suitable decisions for each scenario. The first scenario is when the price of the house goes up to 60 lakhs rupees. Since the bypass road project has come up as per the rumors, the house price has also increased. As per the agreement terms, you have the right to call off the deal at the end of 3 months. Now, with such a significant increase in the house price, will you call off the deal? You will not, because the dynamics of the sale are in your favor. As you can see, the current market price of the house is 60 lakh rupees, but the sale agreement value was just 50 lakhs. This means you have the right to buy the house at 50 lakh rupees, when in the open market the same house is worth a much higher value of 60 lakh rupees. Clearly, you are getting a bumper deal here. Therefore, without any doubts, you would go ahead and exercise your right and demand the developer to sell you the house. The developer is obligated to sell you the house at a much lesser value, simply because he had accepted 1 lakh rupee agreement fees from you 3 months earlier. So, what are you getting out of this deal? The buy price as per the contract is 50 lakh rupees. You have paid an additional agreement fees of 1 lakh rupees, which is a non refundable amount. So, your total expense in this purchase will be 51 lakh rupees. But the current market value of the house is 60 lakhs. In the process, you are saving 9 lakh rupees. So, you are benefiting from the property's appreciation without having to pay the higher market rate. Another way to think about this is that if you sell this house to some other buyer right away, you get to pocket 9 lakhs in profit. Or, in other words, you are making 9 times the value of your initial investment amount of 1 lakh. The profit that you make is exactly the notional loss that the developer would incur. Despite knowing that the value of the property is much higher in the open market, the developer is forced to sell it at a much lower price to you. The second scenario is when the price of the house declines to 45 lakh rupees. It turns out that the bypass road project was just a rumor, and nothing really is expected to come out of the whole thing. People are disappointed, and hence there is a sudden frenzy to sell out the neighboring land. As a result, the price of the houses in the villa project goes down to 45 lakh rupees. So, what will you do now? Clearly, it does not make sense to buy the house as per the agreement terms. Hence, it would be ideal to trash the deal. The reason is quite obvious. Remember, the sale price is fixed at 50 lakh rupees 3 months ago. Hence, if you have to buy the house, he would have to shell out 50 lakh rupees. Plus, you have already paid 1 lakh rupees towards the agreement fees, which means in effect, you are paying 51 lakh rupees to buy the house, which is worth just 45 lakh rupees. So, if you follow through with the agreement, you would lose 6 lakh rupees. Clearly, this would not make sense. Since you have the right to call off the deal, you could simply walk away from it and not buy the house at the agreed price. However, as per the agreement, you will have to let go of 1 lakh rupees agreement fees, which the developer gets to pocket. You can still benefit from this situation if you could instead purchase the house at the prevailing market rate of 45 lakh rupees directly from the developer. This means your total buying price will be 46 lakh rupees, including the upfront agreement fees. In this case, you could end up saving 5 lakh rupees by walking away from the agreement. The third scenario is a little bit tricky. Here, the price of the house stays at 50 lakh rupees even after 3 months. For whatever reasons, after 3 months, the price of the house stays at 50 lakhs, despite the bypass road project turning out to be just a rumor. What will you do now? Well, whatever you do, you would still end up on the losing side here. Why, you may ask? Here is the reason. In this case, you will have to shell out 51 lakh rupees, including the upfront non refundable agreement fees of 1 lakh rupees. But the market value of the property is only 50 lakh rupees. This means you would incur a loss of 1 lakh rupees. Now, even if you drop the deal and walk away, you will still lose the agreement fees of 1 lakh rupees. Clearly, it does not make sense to buy a house at 51 lakhs when it is actually worth 50 lakhs. But since you have already committed 1 lakh, you could still buy the house. But you will end up paying 1 lakh extra in this process. So it's up to you to decide. But let me tell you something. In a real life scenario, you would not back out from this deal because your intention was to purchase this house at around 50 lakh rupees. So you would not mind paying the extra 1 lakh rupees. It would still be a worthy investment as a house is a tangible asset that holds real value. But when it comes to a call option contract, a buyer would not exercise his right to buy, even if the price of the underlying remains unchanged upon the expiration date. The reason for this is quite interesting, which we will understand in the upcoming episodes. If you have understood these transactions clearly, then congrats, because you are already aware about how the call options work. But before we extrapolate this to stock markets, let's just look at some of the key points from this entire agreement. You entered into an agreement despite knowing you could incur a loss. But the good thing is that you already know your maximum loss beforehand, which is the non refundable agreement fees of 1 lakh rupees. This is also known as the premium. This upfront payment ensures that you have the right to exercise or call off the deal at the end date of the contract, and the developer has an obligation to honor your claim if the situation demands. The price of the house at the end of the agreement date determines the outcome of the deal. The house provides the value for this contract. Therefore, it is known as the underlying. The end date of the agreement is also known as the expiration date. Since the developer has received the premium from you, the developer is called the agreement seller or the agreement writer, and you are called the agreement buyer. An agreement of this sort is called an options agreement. As a thumb rule, in an options agreement, the buyer always has a right and the seller has an obligation. The buyer will only benefit from this agreement when the price of the house increases. In the other two scenarios, it is the developer or seller who will benefit from such an agreement. This means there are only three possible scenarios, out of which two indeed benefits the developer. In statistical terms, the developer has 66.66% chance of winning the bet as compared to your 33.33% chance. Let us now proceed to extrapolate the same example in the stock market context. By doing so, the basic concept behind a call option contract will be absolutely clear. Let's say a stock like Tata Motors is trading at 1000 rupees today. Assume you are given a right today to buy the same Tata Motors shares 1 month later at say 1050 rupees. But the only condition is that the share price on that day should be more than 1050 rupees. This means that after 1 month, even if the share is trading at 1100 rupees, you still get to buy it at 1050 rupees. Another catch is that in order to get this exclusive right, you are required to pay a small amount today, say 10 rupees. Now, if the share price rises anywhere above 1050 rupees, you can exercise your right and buy the shares at 1050 rupees. If the share price stays at or below 1050 rupees, then you do not exercise your right and you do not need to buy the shares. In this case, all you lose is 10 rupees. This agreement is called an option contract, more precisely, a call option contract. After you get into this contract, there are only three possibilities that can occur. The first scenario is when the stock price goes up to say 1100 rupees. The second scenario is when the price of Tata Motors stock declines to say 950 rupees. And the final possibility is when the stock price remains at 1050 rupees. Let's quickly go through each scenario and the outcomes. If the stock price goes up to 1100, then it would make sense in exercising your right to buy the stock at 1050 rupees. In that case, your P&L would look something like this. The price at which you get to buy the stock after exercising your right is 1050 rupees. The upfront premium paid is 10 rupees. So the total expense incurred in this transaction is 1060. Now the current market price at which Tata Motors shares are trading is 1100. So the net profit you will receive after selling the stock will be 40 rupees. The second case is when the stock price goes down to say 950 rupees. Quite obviously, it does not make any sense to buy it at 1050 rupees, as you would effectively be spending a total of 1060 rupees, including the 10 rupee premium, for a stock that's already available at 950 rupees in the open market. Therefore, you should not exercise your right to buy. In this case, you will lose the premium amount you paid. The final scenario is when the stock stays flat at 1050 rupees. This simply means you are spending 1060 rupees to purchase a stock which is already available at 1050 rupees. Hence, you would not invoke your right to buy the stock at 1050 rupees. In this scenario also, you will lose the upfront premium of 10 rupees. This is simple, right? If you have understood these scenarios, then you have essentially understood the core logic of a call option. But there are a lot more variables in play, like the lot size, different expiries, changes in premiums, settlement methods, etc. We will talk about all these finer points in the upcoming episodes. Meanwhile, what you really need to understand is that whenever you expect the price of a stock or any asset for that matter to increase, it always makes sense to buy a call option. Now, let's quickly run through an example of put options contract in the stock market scenario. To give you some perspective, a put option contract is similar to a call options contract on many levels. But the major difference between the two is that put options gives the buyer the right to sell the stock or asset at the predetermined strike price at the end of the agreement period or expiration date. Unlike call options, which gives buyer of the contract the right to buy the asset at the agreement date. In short, a put option agreement is used when the option buyer expects a price decline or economic downturn. Let us consider the Tata Motors example once again. Assume Tata Motors stock is currently trading at 1000 rupees in the market. You expect the price of the stock to decline in a month. Assume you are given the right today to sell the same Tata Motors share 1 month later at, say, 950. But the only condition is that the share price on that day should be less than 950 rupees. This means that after 1 month, even if the share is trading at 900 rupees, you still get to sell it at 950 rupees. It is a great deal, right? But here's the catch. In order to get this exclusive right, you are required to pay a small upfront fee today, say 10 rupees. Now, if the share price drops anywhere below 950 rupees, you can exercise your right and sell the shares at 950 rupees. On the contrary, if the share price stays at or above 950 rupees, then you do not exercise your right to sell the shares and you can just walk away. There is no obligation on you. In this case, all you lose is 10 rupee premium paid. This agreement is also an option contract, a put option to be precise. After you get into this contract, there are only three potential outcomes that are possible. The first scenario is when the stock price goes up to, say, 1020 rupees. The second scenario is when the price of Tata Motors stock declines to, say, 900 rupees. And the final possibility is when the stock price stays at 950. Let's quickly go through each of these scenarios and their outcomes. The first case happens when the stock price goes up to 1020 rupees. Then it would not make sense in exercising your right to sell the stock at 950 rupees. This is because the price is already trading much higher than our strike price or agreement price of 950. This means you would effectively be selling at a much lower price when you could sell the stock at 1020 rupees in the market. If you sell at 950, then you would incur a big loss when you buy back the share. Therefore, it is smart to call off the deal. In that case, all you will lose is the upfront premium amount of 10 rupees. This is your total loss. The second case is when the stock price goes below our predetermined strike price of 950 to, say, 900 rupees. Quite obviously, it provides a great opportunity to exercise your right to sell, as you get to sell at a much higher price than what the market is offering. Here is how the P and L would look like. The price at which you get to sell the stock after exercising your right is 950 rupees. The current market price at which Tata Motors share is trading is 900 rupees. The difference is 50 rupees. The upfront premium paid is 10 rupees. So the total profit in this transaction is 40 rupees. This is the total profit you, as a buyer, gets to pocket. But your profit is exactly the notional loss of the writer or seller of the put option contract. Keep this in mind. The final scenario is when the stock stays flat at 950 rupees. This simply means you are effectively selling the stock at 940 rupees when considering the premium amount of 10 rupees for a stock which is already available at 950 rupees. Hence, you would not invoke your right to sell the stock at 950 rupees. In this scenario also, you will lose the upfront premium of 10 rupees. Now, what can you conclude from this example? You entered into the agreement despite knowing you could incur a loss. But the good thing is that you already know your maximum loss beforehand, which is the non refundable amount or premium of 10 rupees. This upfront payment ensures that you have the right to exercise or call off the deal at the end date or the expiry date of the contract, and the seller has an obligation to honor your claim if the situation demands. The price of the share at the end of the agreement date determines the outcome of the contract. The Tata Motors share provides the value for this contract. Therefore, it is known as the underlying. The end date of the agreement is also known as the expiration date. Since you paid the premium to the other party, he is called the seller or writer of the options contract, and you are the options buyer. As a thumb rule, in an options agreement, the buyer always has a right, and the seller has an obligation. The buyer will only benefit from this contract when the price of the share decreases. In the other two scenarios, it is the seller who will benefit from the put options agreement. This means there are only three possible scenarios, out of which two indeed benefits the seller. In statistical terms, the seller has 66.66% chances of winning the bet as opposed to the buyer's 33.33% chance. So this is the basic idea regarding the working of put options. But as I have mentioned in the previous case, there are a lot more variables in play, like the lot sizes, various expiries, changes in premiums, settlement methods, etc. We will talk about all these finer points in the upcoming episodes. Meanwhile, what you really need to understand is that whenever you expect the price of a stock or any asset for that matter to decline, it always makes sense to buy a put option. So, this is all you need to know about options contracts. I hope you now have a fair idea on how these contracts are used with regards to the stock market context. Even if you were not able to grasp the entire concept, don't worry, because we will talk about these contracts in much greater detail in the upcoming episodes. Meanwhile, help this video achieve the target likes. Hit that like button right now. Comment down your queries and suggestions. Also, share this video with your friends and fellow traders. If you are new to our channel or you have not yet subscribed, please make sure to subscribe and support our efforts. Also, enable the bell notification to stay updated about new video uploads. I will see you in the next episode. Till then, bye.